All right, we're going to go ahead and get things kicked off here. So first off, just want to thank everyone for dialing in and joining us here today. For those who don't know, my name is Ryan Staton. I'm managing partner here at StatonWalsh. The topic of today's conversation, we're just going to go through a midway or a mid-year check-in and a halftime report on the markets. We'll also talk a little bit about some of the data that we've gotten from the first half of this year, and then some paths forward through the end of this year. And there's really, to summarize it, there's really two paths we can take, and we'll address those a little bit more. And most importantly, we're going to finish the presentation with some concepts and I think some charts and visuals that I'd really like everyone listening in to focus on and to kind of burn into the back of their minds as they're going through the current market cycle, as well as what we're going to see through the end of this year and beyond. So for those who have not dialed in or listened to any of our presentations, I like to start things off on a lighter note, but this is just a summary or a representation of kind of where we've been this year. I would liken it to a roller coaster ride. The past month has been relatively good. If you've been paying attention as a whole up to date, the broader US market is still down, but there's been a lot of ups and downs. And I think we all kind of agree that we're in this phase of uncertainty. What's coming next? What's going to happen? Every time we seem to turn a corner, something else gets thrown into the mix. And so we'll talk a little bit about what those risks are, as well as how they're going to tie into potential market performance moving forward. So let's just take a review, a quick snapshot of the first half. So where we started, and what you'll see on the various bullet points on the charts are different events that have happened throughout the course of this year. And so when we started the year, the S&P 500 was up around 4,800. And what we saw in January, inflation numbers came out, 7% number year over year. And there has just been a lot of negative news that I think has affected the performance of the market this year. So, it's important to understand that the market as a whole tends to be a leading market. And when I say market, the stock market specifically tends to be a leading economic indicator, meaning it's trying to predict the future. It's trying to predict what it thinks will happen. It doesn't care very much about what just happened in recent history. And so some of these events, while it's seemingly reactionary, where news comes out, the market goes down, ultimately what that is a prediction of and the market trying to predict what it thinks economic conditions are going to be in the future, or what it thinks the outlook is for, mostly I would say the immediate future, looking at the next couple of quarters ahead. But in some cases, it can be a more long-term view as well when we get to an individual company basis. So obviously this chart, not necessarily positive in nature. We started at a high point, and at the end of June have to date bottomed out on the S&P 500 specifically. Since then, market has rebounded a little bit, but this is just the most accurate data as of June 30th. So the next piece is just looking at the market on a broader scale, not just the US markets or the S&P 500, but looking at other indexes as well. So on the top chart, that's a representation, again, as of the end of Q2, June 30th, where the Dow Jones Industrial, S&P 500, and NASDAQ Composite Total Return have finished. On the bottom, that's more of a global approach. So we're looking at emerging markets, developed, international, and then sort of an all-world index with the exception of the United States. So what you'll see, all negative numbers, all in the double digits. Some hit harder than others, particularly the NASDAQ, which is made up in a pretty heavy weighting of technology companies, which on a broad scale have taken a pretty good beating this year as far as individual performance. So what did the experts predict? So one of the things we do is we kind of take at this point in the year, we want to look back and see where we started, what some had predicted, and where we actually are as of today. So at the beginning of the market open this morning, we were around 4,100. But at the end of the year last year, December 31st, 2021, the S&P closed at 4766. So some of the major banks at the end of the year, they review their data and they make their price targets for the following year, what they think is going to happen in the market. What you'll see is that the group average actually predicts a loss in the S&P 500. There are a few that were bullish on the market, RBC, for example, Wells Fargo. Others saw more moderate or a slight growth model, so UBS, for example, but there were many others. Some felt the market was going to decline more significantly than others. So the question becomes, who's right? Right now, none of them are spot on. Some were correct in predicting that the market would be down, but these numbers are based on December 31st. So there's still several months ahead of us where we can look at what the market's going to do, what are economic conditions going to be. And one of the things we'll talk about too is these are really hard numbers to pinpoint for a lot of different reasons. But specifically, predictions are hard. They're really hard to get right. But if we look at the group average, we feel, and the industry consensus has been that the S&P 500 would have a negative year in some form. So let's look at the economic and financial indicators as of June 22nd. Okay, so what we'll see here, green being positive impact on investments specifically. So these aren't necessarily where we are economically speaking, but more so in how these different factors can affect the portfolio. So some can be positive, some can be neutral, and some can be negative. What you'll see is that there's a lot less green than when we did this halftime report this time last year. But in some ways, I think the most negative, and especially in recent history, what we've seen is geopolitical risk is the biggest negative right now. We had a war with Russia and Ukraine. Recent tensions with China have made the market a little uncertain where that goes. Some other things that could be potentially and are potentially positive is that from a U.S. economic outlook, we do feel like long term, there's still upside potential from an economic perspective. Obviously, the first 2 quarters of this year have been negative, which by let's call it book definition would be considered a recession. I know there's some arguments on the semantics of that, what that really means, but as far as what the economy will do moving forward, that's a big question mark. I think there's a general consensus that there's still room for economic growth coming out of the COVID pandemic. And if that were to actually play out, that would be a positive for markets. Some other things that are right now we feel are net neutral, things like inflation, energy costs, and then when you look at equity market valuation. And here's the reason why. When we look at the June data, there's been a pretty significant pullback in several areas of the market. And in some cases, what we would consider bear market conditions. And those have sort of played themselves out in our view. And so typically what happens with the market is that bear markets happen by the time the economic data catches up and we have a full picture of what's going on, and we stamp it and say we are in some form of economic recession. It's happening. By the time that happens, typically the bear market, and this is historically speaking, has really worked itself out. So an average bear market is about 9 months on a calendar year. And so we're through and getting closer and closer to that benchmark. And so what does that mean? That means that there is potential for upside through the end of the year, regardless of the news cycles and what we see. There's a lot on this list that we can feel positive about. And some things that we are certainly concerned about, and geopolitical risk is one of those, where those are things that to some degree as an investor, they're out of your control. There's really no way to plan or buffer for that type of event, but in the same sense, there's a lot of good. So we want to focus on how can we position and create a posture and a portfolio that's going to do what it's supposed to in volatile environments, which is what we're living in right now. So let's talk a little bit about corporate earnings. This chart really just shows the relationship between changes in the S&P 500 and the 12-month forward earnings per share in companies. And as you can see, the two lines have generally moved in the same direction, especially over the past decade. During 2020, there was volatility in stock prices and earnings, as a result of COVID-19. So, as the market rebounded on an expectation of economic recovery, earnings rose, but really not at the same rate as stock prices. So now we have this gap between prices and earnings. And as you can see, this gap has really kind of closed itself in 2022 as stock prices have come down and corporate earnings have still continued to grow. So this is something that a concept that we talk a lot about, in markets as a whole. We tend to have some form of mean reversion. So there have been plenty of periods in the market, and really all that means, to boil it down into simple terms, we're getting back to the averages. Over the course of 2020 and even 2021, we saw this explosive growth in the stock market as a whole. A lot of people did really well, but if you turned on any financial news, you would hear various analysts say things like valuations are out of whack. These are things that don't really make any sense. Why is this the way that it is? And so what tends to happen is we get these periods of overweighting or or excessive valuation, and things really tend to make their way back and revert back to the mean. This doesn't mean that moving forward, the two lines will continue to match one another, but it is something that is important to focus on, in that if corporate earnings continue to grow in specific industries or even in the market as a whole, that usually bodes well for the performance of a broader index. And so there's two ways to look at this. One, if we see a large scale corporate earnings growth, that could be good for the major indices. One of the other ways to look at this is being more precise in our approach to look at industries that do have the opportunity to continue to grow their earnings and maybe have been undervalued over the past couple of years through a very, very growth-centric market. A big topic of conversation right now is inflation. I don't think that it's possible for you to turn on any news and not hear about inflation, some form of rising prices, the big numbers, rising rates, rising prices. There's a lot going on there. As far as CPI and core CPI, you could see there that this chart shows things like 50-year averages, which right now it's been about 4% over the past 50 years. In April of 2022, CPI was 8.2%. And in May, we saw that go up again to 8.5%. Historically speaking, we are definitely above the averages. And that's been cause for concern for many. Is that an indication that the economy is unstable? Is that going to reflect on my portfolio as well as my business, my job? And those are a lot of fair questions. And some of the things that we have seen in the market recently is wage growth has not paced with inflation, but has increased pretty significantly. And so ultimately what happens there is in a tight labor market, you're forced to pay more. Those costs get passed on to consumers in some sense. And so they're going to have to start paying more for that product. That's also going to drive these metrics. What you'll see down below in some of those subheadings is what are the biggest drivers of these inflation numbers. So if we look at headline CPI and we go down the list, what you'll see is food and energy are big drivers of inflation right now. Energy specifically this year, you'll see numbers 30%, 34%. Those are significant, and those are things that we as consumers feel. So the question becomes, how much of this is permanent? The big word that got thrown out at one point last year was transitory inflation, as well as the beginning of this year. I think A lot of people are in consensus that some of that might be true. Some of it is probably permanent. And so the next chart that we'll go through kind of maps out some of the questions and where we think certain areas of the economy that inflation will be sticky and somewhere it may end up being transitory. One in particular, cost of energy. And you'll see here, this is that May 8.6 number, and this bar is representative of each portion or each area that has made up that 8.6%. Energy, a significant portion of that, but one that we have seen a little bit of pullback in the past few weeks. And others that we feel are directly related to things like energy costs, food at home. And so that really just translates to the cost of going to the grocery store and buying the essentials. The things that have trickled down to consumers are high energy costs, the cost of fueling a truck to get produce from point A to point B. That gets passed on to consumers, reflects in this inflationary number. So some of these that we feel are transitory in nature, and I think transitory is a very ambiguous term at this point. Transitory should not be used in the sense that we think it's going to last a couple more months and then go away. I think that there is some staying power in some of this, but as far as seeing numbers like 8.6%, I think those are, for the most part, relatively temporary. So areas like energy, new and used vehicles, and food at home. Places where we feel like inflation is not necessarily going away and that it's going to be relatively sticky. Places like travel and leisure, restaurants, hotels, transportation. Those are industries that were hit particularly hard in the COVID pandemic, and those that are to some degree making up for lost time. We don't feel like those are going away anytime soon. I think for some businesses they can't. The higher prices can't go away. They're necessary at this point for survival. So and obviously in a capitalistic society, people will have choices to make of how much of that they do as far as travel and leisure and some of the discretionary aspects of this. But we felt that looking at the data, a lot of these things will have staying power. And the other is shelter. One of the things that we've seen is that home prices have gone up pretty substantially. Rent has gone up in many parts of the country. It doesn't seem that those are going away. Now, in terms of more competitive markets, there have been some periods of really, really inflated home prices, for example. Here in Maryland, where we're at, that's one example of that. However, we've still seen high occupancy rates at apartment buildings. There's they're relatively full, and we're seeing a higher increase in rent prices, and those occupancy rates have not really been affected to date. So we're seeing rent and obviously home ownership being directly impacted on this when we talk about inflation and rising prices. We have another slide that we'll get into that we'll focus on those numbers a little more specifically, but in any event, we feel those areas are going to be sticky when we're talking about inflation and price increases. So let's talk a little bit about the labor market. I alluded to this earlier, but we see unemployment rates, 50-year averages, as well as wage growth. And so as of May of 2022, we saw that the unemployment rate was 3.6% and that wage growth was 6.5%. With inflation being higher than that wage growth, there's still a gap there, but that's a pretty significant jump than what we've seen from 2021 up until this point. The 50-year averages are about 4%, and the average unemployment rate at that 6.2%, we're technically below the average. One of the things that we are seeing, especially in an inflationary environment, is that throughout the COVID pandemic, we had this the Great Resignation, as we're calling it. And so what happened in that scenario is that a lot of people left jobs, whether to stay at home, care for children. They made decisions and to not work for a particular company. And so the challenge that people are facing now is that things they cost more. That's natural in this type of environment. And so what we're seeing is a reintroduction of some to the workforce. So that could mean that things like that 3.6% number, it could remain the same, or it potentially could go up as more people enter into the workforce in terms of not disqualifying themselves. That's one thing that often gets overlooked in unemployment numbers in general, is that they discount the number of people that are not actively looking for work. So not to say that that's not a that's a good number, but it'll be interesting to see with wage growth, increasing competition, and some other things, as well as increasing costs and inflation for for businesses, how those numbers play out over the next few months. Consumer sentiment. This is really how you and I feel about what's going on in the world today. So this is the University of Michigan Consumer Sentiment Index. It's pretty much one of the most widely used sources to help all of us understand how the average consumer really feels about the economy. It surveys a larger group of residents throughout the US each month and just kind of asks them, how do you feel about the economic environment? And so what you'll see is that in those answers, we're seeing a decreased consumer sentiment. So consumer confidence has been trending much lower in 2022. After all the stuff that we've just addressed, it's not particularly surprising. But this is something that economists and market strategists will also look at. Sometimes consumer sentiment can be a driver of how markets can behave, and specifically how investors behave in the market. One of the things that we will be watching closely is consumer sentiment and spending. Consumer spending tend to go hand in hand. When we think things are going to be bad, we save our money. We don't go out and we don't spend it, which obviously slows economic activity. So if we feel like everything is going in the wrong direction, we tend to take our savings and keep them close to the vest and not go out and spend them. Interest rates will also have a direct effect on that, obviously, as well too. Cheaper debt makes it easier to spend. As rates go up, it gets more expensive to buy things like homes, cars, and anything else, any other major purchases that we finance. So this is something that we should keep a close eye on. What you'll see is that consumer sentiment and various points in recessionary periods goes down pretty significantly. So these grayed out bars are indications of recessions. And you'll see that those kind of correlate pretty closely to big drops in consumer sentiment. So it's not always a perfect metric. Sometimes people feel better about the economy, and they feel better about the future, even though we're currently living in an uncertain economic environment. So this will be a really important metric for us going forward. So let's talk a little bit about the US housing market. So there's a lot of charts on the screen here. I think one of the things to focus on, and obviously the most significant change, is this 5.7% mortgage rate number. This is at the end of June in 2022. Rates fluctuate from time to time, so it's gone up a little bit, it's come down a little bit in recent months, but is a drastic difference from even what we saw a year ago. It's important to maintain perspective, though. I think if we go back, as recently as 2018 into 19, there were some rates that flirted with that 5% line. In the grand scheme of things, it's still relatively cheap money. It's just not cheap in the context of where we are today, or where we've been in the past couple of years, especially with people getting 30-year fixed rate mortgages for less than 3%. But at the other thing that we focus on are things like building permits. What do they look like from a year ago? What do they look like 3 months ago and even a month ago? And so what you'll see is that 6 to 12 months ago, there was a lot of green arrows on that bottom chart. And now we're starting to see a pullback in some of those, particularly in things like housing starts, compared to a year ago and even 1 month ago. So we're seeing that the mortgage rates have gone up. Pending home sales from a year ago are down pretty significantly. at that 13.5% number. But we do see some slightly positive trends in the near term. The question will become, where are rates, and ultimately what happens with values in terms of home price indexes. That seems to be still going up and increasing, which will make it harder for some, that if, especially for younger generations, maybe that have large amounts of student loan debt, for example, may make it harder to qualify for more house. So this will be something that we're going to keep a particularly close eye on to see how these trends continue, or if they continue, and what effect is that going to have on economic conditions through the end of this year. But through the first half of the year, I don't think this is anything particularly surprising. It's been in the news cycles. It's not a secret by any stretch, but it is something that is certainly eye-opening when we look at where we were and kind of where we are today, and just over the last 6 months. So let's take a look at what some market strategists look at, and these are just some metrics of. This is a representation of bottom-up earnings per share, and so this is how a lot of analysts will set their price targets for the S&P 500, for example. And so when they set up this bottom-up earnings per share, they focus their attention on trying to estimate earnings for all of the companies that are a part of the Standard & Poor's 500 index. The contrast to this is a top-down target price, which they place greater emphasis on kind of like macroeconomic conditions when making those forecasts. In this model, they're looking at how are companies, or are companies actually earning money, and to what degree. This chart, what you'll see, again, trend lines, they tend to trend pretty close to each other. We've seen a larger gap in that, partially from the previous chart that we looked at. Earnings have maintained a relatively consistent posture amongst many of these companies, but what we saw is the price target has decreased significantly. And so one way that many market strategists look at this chart, they would say that's a pretty big gap. Earnings per share still look pretty good. There's a potential that there could be some form of bounce back in the major index or in the broader index. And so I don't know that that's necessarily always the case. I think that there will be a much more specific approach to this potentially, but it is something that is eye-opening to see that wide of a gap. It essentially tells us that the market has priced in some predictions of things getting worse potentially, or they felt like things were going to get worse. We've seen a little bit of a bounce back, but it's not necessarily reflective of the health of the balance sheets of certain companies in this particular index. So inflation, we've talked a lot about it. We've kind of harped on it quite a bit in individual meetings as well as in these forums. And so the expectation moving forward is that there is going to be a higher inflationary environment. I think that most consumers believe that. The question is, how will it be moderated moving forward? So, there's an intersection of economic growth and inflation, and that will be critical for investors, since there is an emerging concern of the idea of stagflation. So what is stagflation? It's just an economic environment where there's slow growth, rising unemployment, and elevated inflation. There are some that feel that that's the direction that we're headed in, but the Fed is definitely trying to pursue a more aggressive monetary policy. They're trying to knock down inflation by raising rates on a more aggressive schedule than what they had originally predicted. But the forecast for the 10-year break-even inflation rate, it's going to be based on assumptions, and it's also subject to revisions over time. Long term, the Fed has said that they would like rates to be in that 2.5% range that's where they feel like is a fair break even for inflation over the next decade. And so right now we're obviously way ahead of that schedule, or I wouldn't call it a schedule, but we're way above that trend line. And so the question becomes, when do we hit that break even point? And when that happens, will the Fed pull back their hawkish posture and possibly be more accommodating when it comes to monetary policy? But this is their target line, 2.5%. That's what their expectation is. That's where they want to get rates, and that's where they want to live for the foreseeable future. Right now, we're not there, but that is the end goal here. So, do we believe that inflation is going to be more prevalent over the next few months? I'd say it's a likely scenario. Will it continue for the next 3-5 years? I would say that's much less likely, and probably not a realistic possibility. So what's the outlook? What does all this mean? We're currently in a bit of a trilemma for markets. So we have high inflation. There's going to be more restrictive monetary policy with the raising of the federal funds rate. And then there's signs of slowing economic growth. We've had 2 negative quarters in a row. And so the other side of this is we have an unusually wide range of potential outcomes for the economy and the markets going forward. There's really 2 paths. As I mentioned at the beginning of this, there's 2 paths moving forward. There's a slowing growth and a mild recessionary, where we get into that recession, or can make the argument that we're already partially there, but we bounce back out of that into a period of economic growth. The market recovers, the economy recovers, and we're back on a path of growth moving forward. The other and more severe example is a deep and protracted recession. I will say that it seems that the market has priced in most of what we've seen this year, is considering path A. And I think that's where the general consensus lies. There are some people that feel like there may be a more deep, protracted recession on the horizon. Right now, the indicators that we discussed before don't necessarily dump a ton of eggs in that basket, but it is always a possibility. And so the question becomes, when does that happen, and what does that mean for the market? As I mentioned before, the market tends to be in front of a lot of that data. So what happens is we have a pullback, data comes in, GDP growth slows, we say we're in a recession, here's what we think the outlook is. And by the time we make sense of all of that, the market has kind of already made its way back to some period of normalcy or growth. And so the hard part is getting out in front of that and predicting. And we can't necessarily predict which one of these will happen. We are in the camp of option A and path A. We really do feel that there is there's slowing growth. It's obvious, it's in the data, that we are probably in the midst of a mild recession. What does that mean for the markets going forward? I think that your larger companies that have strong fundamental balance sheets, that have done well, that pay dividends, that have traditionally grown those dividends, are going to continue to do so. They've weathered these environments before. They've been there, done that. I think where the biggest hit that we've seen, with talking about the NASDAQ composite and some other areas of the market, some of the things that we've seen, technology companies that have been spending a lot of money recently, but not necessarily profitable. That's also where we're seeing a lot of the increase in layoffs and unemployment. Carrying a high burn rate at a debt service that's much higher with higher interest rates is more challenging when money is no longer cheap. Also, when investors get skittish and they're not willing to invest money into private companies at the same rate. So this is going to be a recession of certain industries. I would not paint it with a broad brush and say that this is a recession with the likeness of even a 2001 and 2000 through 2002 when we talk about markets specifically in downturns, or a 2008 2009. This is more of a mild recessionary pullback in economic growth. At this point, there is a potential that it could go off the cliff, but it doesn't seem likely based on the data at this point. So again, we're in the first camp. That's how we feel currently. Doesn't mean that, and certainly we don't have a crystal ball. Doesn't mean that that's what's going to happen. But all indications are pointing to that the market does still have some room for growth through the end of the year. It's going to be relatively choppy getting there, but at the end of the day, there, market volatility is a given. I think anytime you invest, especially in stocks, but this is something that we feel is not out of the ordinary, and is certainly not a major cause for concern when we talk about mid to long-term performance of portfolios. So I'm going to transition into some, I mentioned at the beginning of the call, some things that I want you to put in the back of your mind and really remember, and I hope that these will help many of you maintain your perspective as you continue to invest moving forward. So this chart, I'm pretty sure I've included this chart in every presentation that we've done, at least in the quarterly market updates, but this is the most up-to-date for the beginning of Q3 2022. This is the chart from our friends at JP Morgan Asset Management, measuring diversification and the performance of an average investor over time. And so what you'll see is the last 20 years, full calendar 20 years, the performance of various asset classes. Over to the right, you'll see an orange bar, and that's the average equity investor. So what does this tell us? The reason that investors tend to underperform is behavior. And it's specific to times like right now. I mean, I just to be frank and completely honest, what happens is that something happens, there's an event, whether it was COVID, whether it was the housing crisis prior to that, whether it was the tech bubble, whether it was a geopolitical event. There's another chart that we'll talk about to get into all of those things, but there was a change of justification or strategy in your approach to investing in the market. And so when that happens, equity investors, they pull money out of the market, they put money back into the market. And so we have this seesaw effect. What history has shown us is that if we had picked a strategy and stuck to it, any of these, there were going to be periods of volatility, no doubt, especially with some of these, especially with the S&P 500 in 2008 and 9, for example, the peak to trough on that index in particular, over a 16 to 18 month period was about a 53% drawdown. So you lost half of your money if you were just invested in the S&P 500. Really hard storm to weather. But if you had stuck it out and maintained that particular allocation through the end of 2021, you averaged a 9.5% rate of return, and your money grew pretty significantly over the long term. But the trick is maintaining your posture, maintaining your discipline. And so taking that level of risk is hard. Without risk, there is no reward. But unfortunately, what happens is if we take too much risk or we're not prepared for what the market is going to give us, ultimately we make poor behavioral decisions. And that is apparent here in the data. So the average equity investor in a period where if you had bought an index and just rode it out for 20 years, you would have 9.5% rate of return. The average investor got 3.6. Things that did better during that time period, home values. So your home value appreciated faster than your equity portfolio potentially, if you were one that was moving money around significantly in periods of downturn. The other piece to consider there is inflation has been about 2.2% during that period. So your real rate of return is even less. So why do investors underperform? Behavior and not maintaining discipline. So remember this chart, put it in the back of your mind, understand that if I'm going to pick a strategy, I got to be convicted in that and I have to stick to it. Expect volatility. Volatility is a given when you invest in the market in any capacity. I mean, even this year, the bond market, which traditionally has been we'll call it a safe haven in air quotes, has not performed well year to date. It has also been negative. Expecting volatility is a really, really really, it's a really easy concept, but it's harder to, I think, to comprehend or to wrap your head around it when you're in the moment, right? Money is an emotional thing. The market um, is an emotional experience. It's very much a roller coaster. And so what you'll see here is, historically speaking, there have been many instances where the market has been down pretty significantly and has rebounded and even finished in positive territory. So it's easy to say, and I'm sure that many of us in some of these years have looked at this and said, man, this is really, this not comfortable at all. So like 2019, for example, down negative 7%, finish up 29. That's a pretty big swing. There was probably a lot more good days than bad days in that year. But if we look at others like a 2000, and we get into the early 2010s, we've had market conditions where the market was down 19% intra-year. So at some point during a calendar year, the S&P 500 was down 19%. It finished completely flat in that year. So the point being, volatility is normal. Even in good years, there's a really good chance, and you could see from the visual here, there's a really good chance that even in a very good market year, you were probably negative at some point. So the challenge becomes, going back to the first chart, not doing anything in that environment. If you can afford to, and if you can stomach that. Part of that goes into a broader conversation about, are you taking an appropriate amount of risk in your investment portfolio? But I think that's a conversation for another day. The point of this is to say that volatility exists, and there's going to be periods of downturn even in positive market years. So you can see here the average intra-year drop during the data sample of this chart was 14.3% negative, but annual returns were positive in 31 of 41 years. So pretty powerful, and I think a pretty important chart to remember, that there are instances where, and even this year, I know we were down 24% at one point. If it were to finish in positive territory, which is certainly not a prediction, but if it were, that would be another example of pretty significant swing between upside and downside in one given calendar year. Oh, we're out of order here, but that's okay. So we'll just skip to this one. Stocks occasionally give you nothing, so plan accordingly. So what does that mean? There are periods of there are periods of time in the stock market where it returned nothing. And so this representation, or this graph, is a bar graph of the number of years during these calendar years that the S&P 500, for example, returned 0%. So 2000 to 2013, it's pretty significant. And what that means is, if you adjust for inflation and dividends, so inflation numbers are important there, but ultimately you basically got nothing in terms of real rate of return in your portfolio. And there are several instances. Some of them you have to go much farther back on the calendar, but the point being that the market is not always perfect, and it's not always your friend. And so because of that, we have to plan accordingly. You have to plan that part of your asset allocation will not be very good during some periods of time. So one of the things that we tell a lot of our clients is that if we properly diversify a portfolio, we're always going to have to apologize for something. Something is not going to be up to par. And that's natural, because, and that, to some degree, you don't want that. If you have everything moving in the same direction, you're going to live and die by those performance numbers. And so the idea of diversification and having broader exposure is that you can spread out your risk, but also spread out your exposure and get upside in periods of, for example, where the stock market returned nothing. When we talk about the US stock market, there are periods of time, especially on this chart, for example, that other parts of the world or other segments of the market did return pretty significant positive returns. So that's to say that you shouldn't always put all your eggs in one basket, but you should know that one of your baskets may do nothing for you at some point, and you have to be willing to accept that. It's just part of part of investing. It's part of the game. Just like this year, There are going to be periods of loss. And to some degree, we have to accept that with the understanding that we are looking to gain some kind of financial benefit over the long term. Another chart to remember is that politics and investing typically don't mix. So what do we mean by that? Trying to predict what the market will do based on the Congress that we have, the composition of that Congress, or the president who sits in the Oval Office generally does not work. As you can see from this chart, there have been various Democratic and Republican presidents representing the United States. And what we see is that the market as a whole, the index, continued to go up. There were periods where it was flat or it went down in some way, but what we see is a trend, which is growth, a growth trend. And we look at a growth of $1, with the exception of, obviously the Great Depression. You see down there at the beginning of the chart. For the most part, it's been relatively positive. And there have certainly been periods where it hasn't been so rosy, and due to economic conditions, due to a lot of different factors. And so what does that mean? We don't want your political views to shape your bias on investing. It doesn't mean that you're not allowed to have those views. It doesn't mean that they don't mean something. However, when we look at an investment time horizon of the average investor, so all of us on this call have either participated or will participate in the market for decades. During that time, there would be multiple politicians, multiple political parties. There'll be a lot of turnover naturally. And during all of that time, what history has shown us is that that matters to some degree in the moment, but over the when we look at the grand picture, the 10,000 foot view, it hasn't really made a significant impact one way or the other. The other chart is that there's always going to be a smart sounding reason to sell. There's no doubt in today's world, today's environment, the news cycles that we participate in, especially the speed at which information travels, there's always going to be a reason to get spooked and get out of the market. This chart is a list of just a bunch of different things that could have influenced you to pull the plug. So you'll see a lot there. I won't go through all of them individually, but there's a lot of good reasons on this chart to say, you know what, I don't think that the outlook is very good. I want to sit on the sidelines for a little while, and I'm not willing to take the risk. I think that I'm going to try to look into my crystal ball and predict the future based on what's happening today. And what we've seen, again, looking at the trends, is if we start at that 1950 bullet point and we go all the way out into up to recent history, the market went up 100 times after factoring in inflation. So that's a pretty significant and many significant events on this chart, not to discount any of them. And again, in the short term, some of these things mattered. In the long term, 30,000 foot view, if you had been invested, stayed invested, maybe slightly changed your strategy in those periods of time, you still came out in a very positive way. So it's very important to look at, to pay attention to news cycles for some purposes. But if you're looking at a long-term vehicle and a long-term asset, which that's what the stock market is, first and foremost, a lot of these things become insignificant over time. Another question that we get pretty regularly is this a bad time to be in the market? Should we pull out? Should we wait? Should we reposition? All natural questions, all fair questions, and not to discount any of them. However, what we will say is that the data has shown us over the past 20 plus years, these strategies typically don't work. And the reason is market timing is impossible. And so in this chart, we're showing, had you invested 100,000 and just stayed invested, you would have, through various market cycles, ups and downs, a lot going on, you would have $616,000. Had you missed just the 10 best days, just 10 over a 20 plus year period, you only had 282,000. And if you miss the top 25, it's 134. So our point, there is a risk to waiting and sitting on the sidelines. And that risk last month is a prime example of that. The S&P 500 has made its way back slightly. And if you were on the sidelines or you pulled the plug and you got the cash, depending on the timing of that, you're missing out on all of that upside. And those are returns that you potentially may never get back. And so that's a lost opportunity. So it's not to say that some can't successfully do it, but it's very rare. And I would say that in most cases, the data shows us that it's not necessarily valuable to do that. And this chart is a prime example. The other is predictions are hard. This chart is just one representation of that. So this is Wall Street economists trying to predict higher interest rates. So the dotted lines are their predictions, where rates are going. The solid line is what actually happened. What you're seeing is a lot of dotted lines that are running away from the actual rate line on the 10-year treasury. So all that being said, there's a lot of people, most much smarter than I am, that look at a lot of data and attempt to make predictions on that. And a lot of times they're wrong. And so the question becomes, how can we predict the future? How can we hedge against these things? And the reality is, if the best and brightest can't do it effectively all the time, it can't be expected that we can too. So that gets into the idea of maintaining discipline, maintaining a consistent market exposure, and picking a philosophy, a risk tolerance, and a strategic asset allocation that you can live with and that helps you accomplish your goals. And that ultimately, when you get through volatile times like now, you can weather the storm without feeling inclined to pull the plug or move to cash or change your philosophy so significantly that we potentially lock in those losses permanently. The last is success in the market is achieved with patience and discipline. So this is a listing of probabilities, and this goes back, even before we talked about things like the S&P 500. This is, a very long period of time, but the data has shown us that based on what we've seen over history, that your probability of a total real market return that's positive greatly increases the longer your holding period is with a particular investment. So if you hold something a day, you could be, it's a coin flip. If you hold an investment for 10 years, it's a pretty strong probability that you're going to have a positive return. 15 years, and then really once you get to 20, it's 100%. So if we look at this chart and try to make sense of it, the reality is that if you're going to invest in some way, shape, or form, and you anticipate a market participation of 20%, if you can pick a philosophy and stick to it, you're going to have a positive rate of return. In many cases, regardless of what you pick. That's not always the case. It's not perfect, but if we look at just this scenario or this data, the longer you go on that time horizon, the better it gets. And so the question becomes, and what this chart really points out is living in that short-term period is where Wall Street has to live. That's where they need to sell, create money movements to make themselves sound smarter, to be quite frank. Over on the other side of that time horizon, that's where you get to live. If you can maintain that patience and discipline, and knowing that I'm greatly increasing my probability of success just by understanding that if I can hold an investment for 5+ years, that I mean, 80% is a pretty good probability. And then beyond that, once you hold, psychologically speaking, once you hold a position for that long, it becomes much easier to carry that into that 10, 15, 20, and 30-year period. So this is a very important chart. This is something that we really want you to remember and to focus on, is that it is not likely. Those aren't terrible probabilities in terms of like a 1-year period and 68%, but the market should not be utilized in 1-year segments, because the reality is there is still a pretty significant chance for loss. So investing is a long-term play. Success in investing is ultimately achieved with patience and discipline. And with that, I will wrap this up. I know we talked about a lot. We got into a lot of different things. So feel free to use the chat or the questions, the Q&A. If you have any specific questions or anything I didn't cover, or if there's something you would like me to elaborate on. But I appreciate everyone spending the time with us here today. I hope that all of this was valuable. And please feel free to reach out offline as well if you have more specific questions. But with that, I'll turn it over to the crowd and let me know if there's anything else that I can answer or any more insight I could provide. Okay.
Looks like we have one hand raised from Walter. Walter, can you type in the chat box your question?
We can allow to talk to.
Oh, you can, yeah, or you can do that.
Okay, should be able to ask your question live here, so
yeah,
we can hear you.
Can you hear me?
Yes, we can.
Okay, because it says chat disabled.
Yeah.
Yeah, amazing presentation, Professor Staton.
A lot.
Yeah, you'd be a good professor at any university, but no, or even.
I'm done with school.
Yeah, no, you're right. You're probably doing much better where you are, and you're probably right where you should be. You and Mr. Devon as well. Well, thank you guys for all what you do. And no, it was a great presentation. I'm going to print that chart out that shows what happens when you get out and stay out for a few days. And I'm going to take that to my mirror because yeah, it's just a great message. And yeah, everybody should take note of that, particularly the younger ones who don't have the experience, but even geezers like me do silly things. But it's yeah, I looked at some of the data, and I guess I looked at the inflation coming up here in the recent one, and it doesn't, it's up at 9.1 now, and this thing is, and I guess the question is, how does the market anticipate what's going to happen unless they have access to proprietary government data? I mean, there's smart people out there and maybe they're surveying people, but to the extent that the market is able to anticipate and they already factor this in by the time that data comes out, it gives me a little suspicion that some of these people know people in high places in the bigger department and commerce, and they're able to get access to that because otherwise, either they've got a better crystal ball, and maybe that's what's happened. But that's always made me
institutionally speaking, because I think if we're being honest here, institutions are the ones that are still kind of the market drivers or market movers. They look at those things and they anticipate and they try to get what information they can. And partially it's because they want to get ahead of the curve, but some of it is just regular consumer sentiment as well. And so interestingly enough, it seems like in terms of the timing of various market downturns and the news that comes out, I think that ultimately it's a prediction of how they think that information will affect long-term performance of companies, for example. So you mentioned the inflation numbers and where that stands today. I think that's to some degree, some companies or some asset managers specifically feel that some companies are going to weather that better than others. And so the challenge becomes when we look at a broader index performance, for example, especially in recent history, there's been a pretty heavy weighting from some particular companies. So you think the FANG stocks, Facebook, Amazon, Netflix, Google, and the like, Apple, for example, and some of those companies have taken a more significant beating than what we've seen in the S&P 500, but they're also big drivers of that total performance. And so I guess to answer your question, how do they get out in front of that? And the reality is, I don't think that they do. I think it's more of a reactionary, this data is coming out. We know, and they see a lot of that, probably before most of us do, as far as like when a larger institution gets access to that data is usually ahead of like people like you or me if I was just researching it or watching the news. But more importantly, they make a much more I guess I'm trying to think of the word to use to describe this, a much more forceful position on how they feel that will affect. And so that all that really means is buying and selling. I'm selling certain industries, certain indexes, because I feel that my reaction to these numbers are that over the next 6 to 9 months, it's not going to be good for these companies. So I might as well get out now. Just
Right.
cash it in, capture my gains, or cut my losses because it's not going to get any better for me. So I don't want to say they have a crystal ball. I think it's just more of the market is pricing it in because they feel it's a feeling thing. It's very much like the consumer sentiment graph that we went over. It's a feeling that things are not relatively positive based on the data that we're all getting access to at some point. They don't feel like that's going to be positive, and so they make a decision based on that. It's asset managers are also human beings, and what we've seen is that they, as disciplined as some of them can be, there are others that are just like you and I. They're human beings, and so they make emotional decisions. And so it's not always the right decision, and that's why we'll see periods that don't make a lot of sense. For example, rates going up. There was a day in the market not too long ago with not the most recent rate increase, but the one prior, where S&P 500 was up like almost 4% after that news came out. Logically, you would think that that wouldn't necessarily be a good thing, but what happened was their interpretation of that was it wasn't worse than what we thought it was going to be. And so because of that, the market reacted positively. So I think to some degree, it is reactionary in the short term, but it's also a repositioning of, well, this happened. We kind of already knew it was going to happen. Now we have to make an assessment of the future. And so we're just going to take a stab at it, and we're going to reposition our investment allocation accordingly. Sometimes that works out, sometimes that doesn't. But at the institutional level, those changes affect what we see in a broader index pricing, because selling obviously motivates. It's the buying and selling, basic economics, supply and demand. If they're flooding the market with more shares of a company because they don't want it anymore, people start to ask questions, that drives the price down. And so some of this just goes back to fundamentals, singles and doubles, and just understanding the basics of how people think and how the market works as a whole, which is challenging when you're in the moment and you don't think about, and I throw myself, and when I say you, I think us generally as human beings, we don't think of things logically in emotionally charged situations. And we're all guilty of that. All you see is a statement that says negative 20%, and your brain does not naturally gravitate towards, well, why? What's the reason for this? It's, well, I don't know what the reason is, but I know it must be bad. So I need to do something about it. And so sometimes the best action is none at all, which the data has shown us over the long term. The challenge is just when you try to make sense of things over a 3 to 6 month period, which partially we kind of do in these presentations, but it's not easy. There's a lot of data. Now, figuring out what to do with that data is the next challenge. And so our feeling is that a lot of this data is not good for certain parts of the market, but there are still opportunities still exist. We just have to go find them. And so it's a different approach as to the, not to oversimplify it, but the monkey throwing a dart at the wall, which, if I were to describe the past 2 years prior to 2022, post March of 2020 through 2021, it was really hard to miss in the market. And so that's not the case anymore. We have to take a more principled approach again. And for those that have never done that or have not had to do that recently, it's just a reframing. We're just rewiring the circuit board. So this data is telling in a lot of ways. I think inflation is not, it's certainly not going to be good if it persists. Now, the question is, does it persist? And so when the next number comes out publicly and we see it, then my guess will be that if it keeps going up, that the market will not react favor. They will feel that the idea that I talked about, the transitory versus sticky, will become more weighted to the sticky side of things and less towards transitory. And that's not good for the near term, which is really how the market is kind of voting. I don't think most managers and most companies within the S&P 500, none of them forecast on a 10 to 15 year basis. It's all, what are we going to do the next 12 to 18 months? And so the market reacts in that same time frame. And so that's why we see volatility. That's why it is going to be a bumpy ride. Still, want to maintain relatively positive about it, because we do know that over the long term, the cream rises to the top, and the companies that have traditionally done well and weathered storms like this will most likely continue to do so, regardless of inflation or consumer sentiment.
Right. Okay. Well, great. I appreciate that treatise on the subject. But again, great charts, great presentation. Thanks for what you guys do.
All right. Thank you. So I'll turn it back over, unless if anyone has any additional questions, let us know. I think that, we covered quite a bit today. I know it's a lot of information, so feel free to reach out offline. This is also a recorded session. It'll be available after the fact. We'll redistribute to those that attended and those that have registered. And then beyond that, it will also be available in a couple different mediums as well. We'll make it available to all of you, as well as slide deck. So if there are no other questions, we'll let everyone get back to the rest of their day. Thanks for spending time with us today. We really appreciate it. And look out for our next invite. We will continue to do these on a quarterly basis, and we'll have some in between potentially, based on how things kind of play out the rest of this year. With that, I'll stop.